Good afternoon, students. How are you today? And welcome to this great day the Lord has made. Today we are going to look at financial markets, lesson objectives. At the end of this lesson, students should be able to 1. Define the concept financial markets. 2. Itemize the types of financial markets and the advantages of each. 3. Explain the meaning of financial intermediation. 4. State instruments used in different financial markets. Now, what is financial market? The financial sector of any economy is made up of financial institutions, markets, and instruments. A financial market is a market in which financial instruments are traded. By this we mean where financial instruments are bought and sold. Financial instruments include shares, stocks, bonds. So the instruments are the means by which financial institutions acquire funds. Now, types of financial markets. We have basically 3 types of financial markets: money market, capital market, and foreign exchange market. What is money market? Money market is a market for short-term financial instruments or market for buying and selling of short-term securities. It can also be defined as a market for the lending and borrowing of short-term loans. Loans are provided to borrowers for periods from few months to 2 years. So the money market is a market where short-term loans can be obtained between 0 months to at maximum of 2 years. Who are the players in money market? The players or the financial institutions in the money market under the watchful eyes of central bank are commercial banks, finance houses or companies, hire purchase companies, microfinance banks, cooperative societies, brokers, discount and acceptable houses. These are the players in money market. The money market uses such financial instruments as what? Treasury bills, Treasury certificates, bills of exchange, money at call to transfer money from lenders to borrowers. What are the advantages of money market? 1. It helps to encourage savings. Opportunities are made for those with surplus funds to invest. So in money market, you can invest your money in money market. It's easy to recall invested funds. So money invested in money market is very highly liquid, can easily be recalled back. Again, mobilization of funds for investment. You can save through the money market for your investment. Also, it helps to create extra revenue. When you invest in money market, you receive some interest, which is an extra revenue to the investor. Enhancement of economic growth and development. This is made possible through borrowing, made possible by the money market. So people can borrow from the money market and invest, which will lead to economic growth and development. Next type of financial market is capital market. Unlike money market, which is a market for short-term borrowing, capital market is a market where you can go and borrow for medium and long term. Medium and long term. So it is defined as a market where medium and long term loans or financial instruments are traded. Capital market serves the needs of industry and the commercial sector. Financial instruments used in capital markets include shares, stocks, debentures, company bonds, and government development bonds. These ones last for a long time. Unlike capital market, which at most is 0 to 2 years, this one is from 2 and above, 2 years and above, medium and long term. The main business of capital market is carried on through the activities of the following institutions: stock exchange, which is the issuing house, insurance companies, merchant banks, development banks, jobbers, brokers, etc. It comprises all the institutions which are concerned with either the supply of or demand for long-term capital. The difference between capital market and stock exchange market is that in stock exchange market, of course, stock exchange market deals with already existing shares, old shares. This one, in the capital market, new ones, most times, and they lend for a very long time. So the difference between capital market and stock exchange is that capital market is a market for long-term loan, yes. Here you borrow for a very long term. While the stock exchange market is a specialized market for the buying and selling of securities, already existing securities, old ones, not new ones. That is claims to loans or shares. Capital market can be divided into two. We have primary market and secondary market. Primary market is a market for where you can buy new securities, new shares. When new companies want to sell shares, new shares, they go to primary market. But secondary market, here here all securities or all shares are traded in secondary market. So the primary market deals with the buying and selling of new securities. SEC is at the apex of primary market. Unlike ordinary financial institutions where CBN is in charge, when it comes to securities, Securities and Exchange Commission is the apex, is in charge. On the other hand, the secondary market is a market for buying and selling of old or second-hand securities. It is dominated by stock exchange. So secondary market is dominated by stock exchange, while primary market is where you get new shares. Old shares, secondary market, new shares, primary market. But all of them are under the control of Securities and Exchange Commission. Now, what are the advantages of capital market? 1, provision of long-term loan to the private and public sectors for investments. 2, they mobilize savings. Savings are mobilized in the capital market. Capital market also encourages the growth of merchant banks. 4, the general public can also participate in the running of the economy of a country. Those are some of the advantages of capital market. The last financial market we have is foreign exchange market. What happens in foreign exchange market? The foreign exchange market deals with exchange of foreign currencies. Exchange of foreign currencies in a country. So this is a market where major foreign currencies are exchanged with the local currency. The participants, who are the participants? Just like when you go to primary market, who are the participants? If you go to stock exchange market, who do you see there? In the foreign exchange market, who are the participants? Here, we have the Central Bank of Nigeria, we have commercial banks, we have the Bureau de Change, independent autonomous suppliers of foreign exchange. These are the participants in a foreign exchange market. Remember, we said that we have 3 types of market, 3 types of financial market: money market, capital market, and foreign exchange market. Money market is a market for short-term loans, or market where short-term loans are traded, while capital market is a market for medium and short and long-term loans. Finally, foreign exchange market is a market for exchange of foreign currencies, where foreign currencies can be bought or sold. So central bank is at the helm of it, or have commercial banks, you have Bureau de Change, and then autonomous suppliers of foreign exchange. Instruments used in the capital market are, we have shares, we have debentures. So what are shares? What is a share? Or what are shares? These are financial instruments utilized in the capital market for long-term investments. A share is a certificate of ownership. If you're a shareholder in a company, it means that you must have a certificate that you are now a participant, you are a co-owner of a bank, or a co-owner of any company whose share you have bought. A share is a certificate of ownership and confirm the proportion of a limited liability company owned by an investor. So once you buy the share of any company, you become the company's shareholder. That means you're a co-owner with the original owners of the company. Other instruments used in capital market, apart from shares, we have bonds. This one is a long-term financial security used to source for funds. What is a bond? Bonds have certificate of indebtedness, showing the amount the user is owing the bondholder. Bonds may be issued by firms, financial institutions, or governments. Bonds issued by the government are generally regarded as very safe. So we have shares, we have bonds. Bonds are normally issued by the government, more often than not by government. Like we have said, they are very safe. Debentures. Unlike a shareholder who is a party, who is a co-owner of a company, a debenture holder is a creditor to the company. Whoever has issued the debenture to the debenture holder is a debtor. The person is owing the debenture holder. So debenture holders are liabilities to the company. These are secured loans raised by a company, usually with fixed interest and sometimes fixed redemption rates. So if a company wants to borrow, limited liability company, they want to borrow, they can issue debenture to people. It's a certificate showing how much the bank is or the company is indebted to you, the interest rate, and then, if possible, the date of redemption. Equally, we have Treasury Certificate, even though this Treasury Certificate ought not to be here. Treasury Certificate obtains in a money market because it's a short-term instrument for borrowing. All this, and what is Treasury Certificate? These are government financial securities which mature after a year, last about 360 days. They are issued by the government through the central bank to either borrow or lend in the market. Treasury certificate is mostly used by the government for short term. Next, we want to look at brokerage and financial intermediations. Some institutions and markets within the financial sector ease the funds transfer process simply by providing a brokerage service, bringing borrowers and lenders together who otherwise might not have been able to see each other. The financial sector eases the flow of funds of the two groups by creating financial products and offering financial services which reconcile the opposing needs. The process of reconciling the needs of service providers and borrowers is termed financial intermediation. So brokerage is paid to brokers. A broker is somebody who operates in a stock exchange market, in a capital market. They trade there. We have jobbers, we have jobbers and we have brokers. Brokers mediate between the jobbers and the individuals that are buying securities. The jobbers mediate between the brokers and the financial institutions. So financial products, what are the financial products used by this for intermediation? To intermediate means financial intermediation, you're intermediating between two people. Here, borrowers, savers. So financial products or financial services. These are products. What are they? These are products and securities raised by the financial institution in the process of mobilization of funds from the surplus economic unit to deficit economic unit. The financial products include the following: shares, bonds, medium to long-term debts, short-term debts, treasury bills, promissory notes, commercial papers, bills, banks' acceptances. So financial products or financial services are those instruments used by financial institutions to get money, to borrow money, to get money, are called financial products. We've talked about shares. What are these financial products? They include shares. Remember that shares means those who owe, who are members, who are people who have bought shares are the shareholders, the owners of the company. Bonds are sold. This one is a medium of borrowing for a very long time. Mostly the government issues bonds to borrow money from the public. Medium to long-term debts, these are the ones that ranges from 3 years to about 30 years. Short-term debts, these are for borrowing for short, normally 0 to 2 years. Treasury bills. Treasury bills is a form of borrowing, an instrument used in borrowing. Treasury bill normally lasts for 91 days. Promissory note is an IOU. Who prepares the promissory note? The person borrowing the money. He makes an OU, takes like an oath. Hold this thing, that for so a period of time. After that, I'll pay you your money. Commercial papers are used for international, these ones for international businesses. Banks acceptances. If you borrow money from somebody, or you're making international business, and then if your bank, you can approach your bank to come. It's like the bank is vouching for you. It wants to bring bank's acceptance. The international man will always accept it from you, because the person is now very much confident that at the expiration of the time, he or she will get his money, since the bank has vouched for you. These are financial products used in financial institutions. So like I said, bank acceptance is a time draft or bill of exchange or insurance draft drawn by one party and acknowledged by a second party. The acceptor stamps or writes the word accepted on the face of the instrument and the place and date of the payment above his or her signature. Once the draft is accepted, it carries an unconditional obligation on the part of the acceptor to pay the drawer the amount on the draft on the date specified. So like I said, your bank can sign for you to authenticate, vouching that you have such an amount of money that even if you fail to pay, they will indemnify the person. There are two types of acceptance: the trade acceptance and the bank acceptance. A trade acceptance is a draft drawn by a trader or a manufacturer on the buyer and accepted by himself or herself. A bank acceptance is a time draft, not exceeding 6 months, across the face of which the bank has written the word accepted to indicate that the bank will honor the draft upon presentation. So these are some of the instruments which financial institutions use in obtaining fund. Evaluation. The following questions, write them down so that you can attempt them at home. What is a financial market? State 2 types of financial markets. 3. Give 2 advantages each of money market and capital market. Then copy down the following answers.